All right, Jigar Mistry is here with us to talk more about markets. Jigar, between the last time when we spoke over coffee and now, there has been a very smart correction which has played out. Are you starting to see good risk reward stories in the market, and have you started nibbling in your new portfolios the additional flow which you're getting?
Good evening, good afternoon, Ajay. You're exactly right. From market not willing to even consider the fact what a rising interest rate scenarios mean, I think they are now acting on the opposite end of the spectrum. So whereas the Fed fund rate has been hiked to 1%, markets are now pricing in a lot. So US 10-year is already at 3.14. India 10-year is at almost 7.5 versus 4.4 on the repo. Now, to answer your question, I think two things are critical. I think we have, as market participants, we have committed two grave mistakes. One is that we have not paid adequate attention to what, valuation of companies look like in a scenario where interest rate is high and inflation is exacerbated. And secondly, we have become very, very path dependent, right? Let me elaborate on that. We initially thought by assuming that if the value of the asset is fair at 150 and we are at 100, we naturally believe that 100 will tomorrow go to 110 and 3 months down the line will go to 120 and in straight line go to 150. That both those myths, the fair valuation at 150 and the path dependence has been seriously questioned. And given how markets oscillate, I think it has oscillated from one end of the spectrum when it was not willing to price anything to the other end where, everything is completely shattered. I think we now need to take into account the fact that, there has been some semblance of reality which is taking in and a lot of sectors have become interesting for one to start looking at it very constructively. I did discuss the last time that it's almost 6 months now that we have what we call in our defensive stance, and we are now getting reasonably, good companies at valuations that do make sense. So yes, that things are looking interesting now.
Jigar, are you expecting positive returns from the market from current levels 1 year far out, 2 year far out? And in your portfolio also, how have you scaled back the forward earnings?
Right. So I think, Ajay, one thing we need to take into account is that the quality of earnings is undergoing a sea change. Right. Over the last 1 year, so say fiscal year 2022, four commodity companies, which is Tata Steel, JSW Steel, Hindalco, and ONGC, which together contribute only 4% of the weight, have accounted for close to 50% of incremental profits of NSE Nifty 50. I think that goes in to tell you the materiality of the kind of commodity price inflation that we are seeing. Secondly, we also need to take into account how crude prices get absorbed into the corporate profitability. So, we import 1.7 billion barrels of oil, translated into annual import bill that comes to something like 4.2 lakh crore. Right, we sell 14,000 liters of petrol and diesel, and on which prices have been hiked by 10 rupees. So we have managed to pass on something like 1.5 lakh crore, which leaves the question of almost 2.5 lakh crore to be either passed on to end consumer by different companies and therefore lead to higher inflation, or to be absorbed in corporate profitability. Now the size of corporate profitability is only 7.5 lakh crore. I'm talking of BSE 500 companies. So on one end, you're looking at the structure of the profitability changing to companies which are traditionally valued at a lower PE, and the total quantum of the profits reducing in the wake of higher crude prices. To answer your question, I think we have had 6 consecutive calendar years of positive market closing. We have never had a seventh year in this millennium. The last time we had it was 1988 to 94. And, the markets didn't come back to the same level till 99. So I think, we have had 15% CAGR on Nifty. A lot of alternatives and mutual funds have managed to do a lot better. I think it will be good if we take our, expectations a little slow uh, from where we are at the moment, a lot of sectors and company do offer a reasonably good risk reward from a year to year standpoint. But we need to go in, assuming that market returns will be a little bit tepid for some time to come.
Right, Jigar. In fact, market is a beast which does give returns in very lumpy manner. In the last 2 years, perhaps we got returns of 3 4 years bunched up into 1.5 2 years. So 1 or 2 years, if they turn out to be lackluster or flattish, one is okay. But if I were to take 4 to 5 year view, do you see 15 18% CAGR earnings and hence CAGR returns possible in that time frame, 3 to 5 year time frame, even from these levels?
I would think so, Ajay. So let me break it down. Say in very long periods of time, your earnings, and stock prices tend to mimic each other, right? Now, if you're talking of India's economy growing at 6 to 7% real terms, you add another 3 to 4% inflation. That's 10 11% growth in nominal GDP, which includes agriculture GDP. So if you remove that to arrive at a corporate profitability, you're looking at 12 13%. Now, one anecdote we need to take into account is that the GST collections are running at a far higher pace than your nominal GDP growth, which tends to reason that a large part of earnings or the large part of industry is coming towards the more organized type. And therefore, 12 to 13%, which would have been the overall GDP growth, you could arguably stretch it to 13 14% for the organized listed space. And if you make a reasonably good assessment and outperform by 3 to 5%, then the number which you put forward, which is 15 to 18%, is not a very far cry. But as I said, in order for us to do that, we need to take a step back, assess the right valuation of the companies we are dealing with. Right? Many of us have a time frame, which is very close by and have a recency bias. So we look at 14 to 18, 19 sort of years and understand how great consumption stories were. But we tend to forget that this was a period devoid of any commodity price inflation. And therefore, the PE re rating from 30 to 40, going up to almost 60 to 90, is something that might not recur. So you might have to be a lot more realistic in terms of how you arrive at a fair price of your assets, and then be a lot more dispassionate and path independent. So if you're buying something at 100, which is worth 150 or 2 years down the line, if you do not terribly worry if it goes to 70, 80 before it goes to 150, then I think that is how a large part of the money for the next 2 years will likely be made.
Okay, one last word then. What have you been, what areas, don't tell me stocks, but what are the areas you've been nibbling in the last 2 3 weeks or maybe 2 3 months?
Sure, Ajay. So, if I break it down in terms of extending our conversation, then consumption, as I said, will likely see negative growth in earnings and PE compression, which is why we are ignoring that sector. Manufacturing will be very case by case. That 2.5 lakh of 7.5 lakh profits needs to be passed on, and therefore there are a few sectors like few auto ancillaries which look very interesting. A few sectors in chemicals still continue to look interesting. Pharmaceuticals look interesting. So we are selectively positioning in those sectors. And lastly, services broadly appear unscathed both from an higher interest rate or a higher commodity standpoint, right? What will impact them is a second order derivative impact, meaning that the companies, like say banking, for example, is not immediately impacted by higher interest rates, but the consumers might have a lesser disposable income and therefore lower fees in the second derivative order. So I think you can look at insurance, banking, select technology. All those names appear a lot more interesting as we break down what we need to buy, given the market weakness we're talking about.
Thanks very much for joining us on the show today.